Welcome back, fellow investors. Let's have a look into Intel's earnings today. I'll show you if they were indeed that bad, why the price was falling, and why I started to change my mind about Intel. At the end, I will also show you my updated valuation for the company. But hey, let's get straight into the numbers and show you some of the information behind the headlines. In my opinion, headlines should not be considered as good input for making long-term investment decisions. So what we can see based on the quarterly revenue of $19.5 billion is that the client computing group lost 7% year over year. According to their CEO, Pat Gelsinger, this is mainly to do with supply constraints, which we all are aware of due to the demand spike, but also the supply disruption as a result of the pandemic still in 2020. On the other end, the data center group grew 20% year over year and is really a significant business unit at the moment, already bringing in $7.3 billion in one quarter alone. This should not come as a surprise if we see companies like Microsoft and such announcing record earnings and 20% year over year growth, mainly due to, for instance, the business of Azure. What is also interesting here is that Mobileye in the last quarter alone made about $356 million, which is really interesting because the company lately decided to spin off this business in an effort to create further shareholder value. At the same time, the company also increased their dividend by about 5% to $1.46 per share per year. As a dividend investor, I really like this because it's continuing to grow my passive income going forward in the years to come. On another note though, what we can also see is that they brought in $11.3 billion in free cash flow, and I will show you later what the impact is of this and what the comparison is compared to last year. But hey, overall, we can see that their revenues continue to increase, which is really interesting because there is this really strong narrative that Intel is a dying company. And I understand this narrative really well because until Pat Gelsinger came in, I had exactly the same thinking here. I personally found it more a company to be like IBM than, for instance, to Microsoft that is currently firing on all cylinders. But let's go still a little bit deeper because this actually doesn't really explain to us, of course, why the price is dropping with 7 to 8%. Why is this happening? Because if we look at it, they say this has been the best year ever, bringing almost 75 billion in revenue. And factually, that is totally correct. And also look at it, a gross margin of 57.7% over the whole year. These are really strong margins if you think about it. At the same time, an EPS of $5.50. You need to know that the company is currently trading around $48. So with that, you're getting it for approximately a multiple of, let's say, 9. And honestly, I think actually that all investors agree that these are great numbers. But you know, investing is really not only about looking at the past and extrapolating this into the future. We know already that Intel is heavily investing into the future. And what is becoming apparent right now, that this is going to cost a lot and impact significantly gross margins. Because according to their outlook, Q1 this year, they expect a gross margin of 52% going forward and an EPS of 80 cents. Now, this is a big impact, right? And this has really to do with their investments. But let's not look too much at this 18.3 billion to compare it with last year, because it really excludes the discontinued operations from their NAND business that they decided to sell to SK Hynix. I believe it's a Korean company, for 9 billion. Their annual revenue of that was, I think, something more than 1 billion. So this is now being excluded out of the revenue figure. So when comparing year-over-year revenue numbers, then please take this into consideration. But back to the margin, because margin is the real reason why this company is going down at the moment. Look at it. In 2012, the company had still a gross margin of 62%. It just tells you that they had a lot of pricing power, a lot of innovation behind it, and they were at the top of their market. Then AMD came along, started to really compete, and you can see a gross margin decline over the years. Currently already dropping towards 52% next year. This is really a pure fact of increasing costs going forward, and it was also discussed in the earnings call because Vivek Arya from Bank of America Merrill Lynch actually pointed at this. He was really asking about more information about the margins, and Dave Zinsser, the chief financial officer of Intel, gave a really good response. And here it became really apparent that it's all to do with the investments and, for instance, the needed ramp up for the 10 nanometer. So they presented a range of somewhere between 51 and 53% in gross margin level, so 52% is their guidance. Also, Pat Gelsinger responded to that, and he explains it even better because the foundry business that they are initiating will be a lower margin business, but it will have to be compensated with higher margins by their high-end business, for instance when it comes to designing chips. And this is it, guys. This is the narrative currently going through the market, why Intel deserves to be trading at a lower price. But look, I really love these short-term reactions from the stock market and Wall Street because it might actually just give us really great opportunities to buy more of this company. So let's do a little bit more digging into the numbers even further to understand as cash flow investors, what are we really talking about when we look into the year-end numbers. And there's only one place where we can really go, and that is the 10K. Those are the main statements that I really trust. So what we can observe here is that the costs are already increasing. You can see compared to last year, there's already 1.5 billion, so around 12-15% more invested in R&D. And at the same time, the company is restructuring, for which they had to charge 2.6 billion in this year alone. That's the main reason why the operating expenses are also almost 4.5 billion more, which of course has an impact on the bottom line. You can also see that the provision for taxes was much lower, probably because of those write-offs, and that's why we are looking here at the earnings per share diluted of 4.86, which effectively translates to a 10 PE at the moment with this share price. But where the really interesting thing comes here is for me the balance sheet, and I'll show you that. Because with the money that has been incoming, they have been increasing their trading assets already with 6 billion, which is a lot. But at the same time, you can also see the property, plant and equipment going up. So this is all nice. So effectively, the company assets grew from 153 billion to 168 billion. So it's really an asset expansion currently of 10% growth just this year. And the nice thing about this is that it's not a debt-funded growth because the debt didn't increase. Actually, to the contrary, because they even reduced a little bit of the long-term debt. But look, you can see it back in the stockholders' equity, which also grew with around 15 billion. This is value going to the shareholders, not to the banks, but to the shareholders like you and I in case you own some shares of Intel. So as a value investor, I really love to see this. But now let's go to the cash flow because this is something really interesting to look at compared to last year. What we can see here is really the impact of working capital. As an example, their operating cash flow went down by approximately 5.4 billion. This is a lot. This is still excluding the investments that have to be made and are part of the free cash flow. But look here, their accounts receivable, so the money they still need to get from their clients is 2.6 billion. So they have still outstanding bills that need to be paid and therefore there was no cash coming in. It might go into the earnings, but you cannot keep it in the cash flow. But the inventories is the same because this is now 2.3 billion compared to 700 million last year. At the same time, they also prepaid customer supply agreements of 1.5 billion, which I think is a result of their deal with ASML. And this is good news because it means that Intel started to already buy this modern equipment, which is really expensive, which should allow them to get into competition again with AMD and TSMC. But hey, this explains also therefore why the OPEX is really down, because it has to do all with working capital. You need to look at this over the years, so I expect the cash flow from operations to have a positive effect again in 2022 because these are usually one-offs, but overall, over time, these flatten out and balance out. So this year's cash flow has been really hard impacted. But if you then deduct from the almost 30 billion in operating cash flow, the 18 or 19 billion in capex, yeah, then you get to a free cash flow of 11.3 billion, which is much lower than the 21 billion in free cash flow from last year. Honestly, this really sounds like a kitchen sink quarter for the company, so that they are setting themselves up for beating expectations on cash flow next year. I think this is quite smart, and this is what Pat Gelsinger is doing now. But this also means that we need to take this into consideration when we are modeling the fair value of a company. But look, before we go into the calculation, why did I change my mind on Intel? Because the last time I spoke about Intel, I was still like on the sidelines, not being sure and such. But lately there has been so much news out about Intel, which really tells me that Pat Gelsinger is totally on it. He's really on fire. But look, for instance, I already mentioned they will do an IPO of Mobileye and Intel will even keep a stake on it. It is estimated to be worth something between 30 billion and 50 billion. There will be coming a significant amount of cash coming in already from this acquisition because I believe they bought it at the time for, was it 10, 12, 16 billion? So this already could mean like a tripling of their investment just in few years. At the same time, we just saw the announcement that also Intel is investing in the equipment from ASML, which should give them really the high-end manufacturing capabilities again to compete with companies like TSMC. But that's not where it stops, because also, like a few days ago, the House of Representatives in America unveiled a bill aimed at increasing competitiveness with China. So they really want to bring back production to America. 52 billion is to be subsidized to the semiconductor manufacturing and research. Well, guess where this is going? I can tell you a lot of this is going to Intel. I believe that even Biden was calling Pat Gelsinger the big chief in command here. But this is just the news. But look at the fun these engineers are having with overclocking the CPU of Intel to break the world record.
Dutch is here, and he's here with his partner, George Giannopoulos. Hello, gentlemen.
Great to be here.
Thank you for joining us.
No problem.
And just for a little bit of fun, they're going to take the Core i9 12900K CPU on a Z690 motherboard, and we're going to try to break world overclocking world record right here on stage as we sit here. Okay. Now, you can see them pouring the liquid nitrogen in.
I'm sure you get what I mean. Actually, the fun fact is they failed on the first time, but later in the show, they broke the world record. This is what you expect from a tech company. Bob Swan, the former CEO, is out. He was really poor in this, and we've got the geekiness back at Intel. And this is why I'm telling you why I'm really becoming bullish on Intel. I have a feeling that I'm seeing the same transformation here that was happening at Microsoft at the time. When Satya Nadella came, fun came back into the company. And I really believe that this is important because in the end, these kinds of tech companies are really about the talents that they can acquire into the company. And we are seeing already some developments here because even the CFO from Micron decided to come to Intel. All these kinds of announcements are just building up on my feeling for this company, and I believe it's really clear from how I'm talking right now. Okay, but before I get too enthusiastic, let's get back into the data to keep my feet back on earth. As a dividend investor, I find the dividend history really important. They have frozen their dividend in 2013 and in 2014, which effectively means that they have a dividend growth year and track record of 8 years, but it is longer because before that they were also growing their dividend. All the metrics almost are on green for me, except for the Chowder rule, because for that it needs to be 12%. It's almost 12%. I don't think we will see 5-year dividend growth of 8.7% again. We know already the last dividend growth was 5%, and I expect this to continue like this while they are heavily investing back into their business. With having said that, I believe therefore also that the free cash flow payout rate will go up more towards the 50% because there will be more cash flow outgoing, which means that this number will automatically go up. Credit rating, A+, really sound balance sheet. Look at the debt to equity. They could pay off most of the debt really quickly. And this is still a value generating company. Their return on invested capital is 10% higher than the cost of capital, which means that for all the investments they do, they're earning shareholder value. It's a really important metric. I would also like to really give a bear case here. So in my opinion, the strategy of Intel is really risky and really bold, but it could mean that they are not able to close the gap with TSMC. TSMC is actually outspending at the moment Intel. You need to be aware of that. So it's not a given that Intel will be able to get back its leadership position. And the same applies to AMD. The gap is big and they might not be able to close it. In such a case, Intel might be really expensive at the moment. Secondly, there's of course a really big wave of digital everything. However, how long will this continue? I still think it might be for 10-20 years, also with the EVs industry booming. But who knows? This is a strong assumption that needs to be kept in check every time, and that's something that I will be doing as an investor. I really need to continue managing these risks going forward. So having said that, let's quickly jump into my fair value estimate again, and I'll show you what has changed since the last time I presented this to you. So the last time that I presented this to you, I believed that the fair value of the comp would be $54.62. That was assuming over 2021 a free cash flow of $6 billion. Because I was thinking already that a lot of these investments would be made in 2021. So we now know that this was $11.3 billion. So if we run with this, you will see that the fair value increased a little bit with $1, 55.50. All other assumptions I'm keeping the same. I think that these investments will take 4 or 5 years and then they will be back on track again with proper free cash flow coming in. That's how I'm modeling this. At the same time, therefore, I'm using a growth rate at that moment in time of 7% with a discount rate of 10% and a terminal multiple of 15. But maybe I'm too conservative and it might actually grow with 10% thereafter. In that case, this company might be heavily undervalued with $105. However, if Intel's not being able to close the gap, for instance, with TSMC and AMD, and there would be a continuous decline in growth rate over the next few years, for instance by 5% decline, and after that a small growth rate more or less in sync with inflation, and at a discount rate of 10% and a terminal multiple of 12, then the company might just be worth $28. This is the downside risk if the bear case scenario plays out. As I showed you before, I'm really becoming bullish on Intel, and I really believe in Pat Gelsinger as a CEO. He's really on it. Hence, I believe that a fair value of $50 or even more is really not unlikely, and that's why I decided to start initiating a position in Intel not too long ago and decided to buy some additional shares yesterday at $48.40. I've also sold a put option with a strike price of $40 and expiry date in June, which gave me about $155 in premium, and I will be more than happy to buy 100 shares at such a price. Having said that, if you would like to learn more about how to value a company like I did, then check the video on the left. And if you would like to learn more about HP Inc., then check the video on the right. Have a great weekend and week ahead. Ciao ciao.